Financial Accounting Chapter 12. Introduction. Tax accounting is a structure of accounting methods focused on taxes rather than the appearance of public financial statements. Tax accounting is governed by the Internal Revenue Code, which dictates the specific rules that companies and individuals must follow when preparing their tax returns. International differences in the determination of taxable income. Taxable income refers to any individual's or business compensation that is used to determine tax liability. The total income amount, or gross income, is used to calculate how much the individual or organization owes the government for the specific tax period. The taxable income of a company is determined by ascertaining assessable income and then subtracting all allowable deductions. The basis for calculating the tax payable is determined as the difference between total revenue and total expenditure of the taxpayer, in amounts determined in accordance with accounting regulations. Tax rates and tax expenses. A tax expense is a liability owed to federal, state, provincial, and/or municipal governments within a given period, typically over a year. Tax expenses are calculated by multiplying the appropriate tax rate of an individual or business by the income received or generated before taxes, after factoring in such variables as non-deductible items, tax assets, and tax liabilities. Tax expense equals effective tax rate multiply taxable income. Calculating tax expense can be complex, given that different types of income are subject to certain levels of taxes. For instance, a business must pay payroll tax on wages paid to employees, sales tax on certain asset purchases, and excise tax on certain goods. Deferred tax. An important concept to explain about deferred tax is that of temporary taxable differences. This occurs when a business has an asset with a liability value that does not match the current taxable value of the asset. This can happen when the accounting approach and tax laws differ in how the depreciation of an asset is handled. A deferred tax liability occurs when a business has a certain amount of income for an accounting period. That amount is different from the taxable amount on their tax return. When the amount is less than the estimated tax, an entry is placed on the balance sheet in the form of liability. Deferred tax typically refers to liabilities, wherein the amount entered on the balance sheet is payable at a future time. However, deferred tax can also apply in the opposite sense. Example of a deferred tax liability. Company XYZ owns machinery that is classified as an asset. They choose to use a certain depreciation method, in this case, an accelerated method that allows higher deductions earlier in asset ownership and lower deductions further on. This differs from the slower, straight-line depreciation used by tax authorities, which means the depreciation is spread evenly over the useful life of the asset. The depreciation method affects how much the charges will be for each accounting period. These charges can be claimed for capital allowance. Because the depreciation method chosen by company XYZ would result in a larger deduction than the method used by tax authorities, their income would be higher than what would be considered the taxable income. In this case, the temporary difference would be added as a liability to the balance sheet.